Oil spiking again this morning. It looks like we could get to $90 US for the North American benchmark at this rate. Biggest weekly percentage gain since the pandemic, the volatility back then. And this, of course, is because shipments through the Strait of Hormuz have essentially been shut because insurers don't want to know about covering vessels going through that crucial waterway. Let's get more from Patrick O'Rourke, Managing Director at ATB Cormark Capital Markets. Thanks very much for talking to us, Patrick.
Thanks for having me.
One thing that strikes me, though, we've seen past Middle East wars, oil went up for a bit, then dropped. Could it be different this time?
Well, we published a report Monday morning. It was called Northern Pivot. One of the main things, the takeaways there is that it's a very dynamic and volatile situation, and that a lot of the things that we published were speculative. Could the duration of this be longer than initially anticipated? That's very possible. And that's the way it seems that it's trending today. The other unknowns for us would be how much damage is actually done to production reservoirs, to oil egress through the conflict. And then, the third unknown would be, what do things look like on the other side? Do we have governments that are generally favorable to, regime change in Iran that's favorable to Western nations, or do they double down? So we're still trying to digest all those things. If you look at the crude tape itself, most of the movement, the extreme strength that we're seeing today, is at the front end of the forward curve. We haven't seen quite the same move out into 2027 yet. That's moved up probably only $5 at this point in time. So the market would, be suggestive of today that this is going to be somewhat shorter in duration, but that duration is certainly lengthening on a day-to-day and even minute-by-minute basis.
And it sounds like even Iran doesn't need a big navy or anything to disrupt traffic. It just coast guards are randomly shooting at ships, apparently, and that's enough to deter traffic.
Well, and tanker freight rates have gone up, and insurance has become a challenge. I know the U.S. administration has said they're going to step into that market. We're still waiting for specific details of how that's going to look. So that would, today, that would be an impediment to moving a ship as well.
Fascinating as well, Qatar, there's a headline on Bloomberg. They seem to have just loaded their first LNG cargo ship since declaring force majeure, a warning they couldn't get LNG to customers. But they must be extremely disturbed because they have pitched themselves as a reliable source of liquefied natural gas.
And they have ships that are sitting there boiling off LNG right now. So, one of the takeaways from our report was that waterborne gas markets were probably some of the most vulnerable that were out there. You think about the situation, Europe relaxed some of their storage reservoir or storage fill requirements for natural gas heading into this winter. And so they're sitting at 5-year lows in terms of gas storage. And then you think about the structure of the Asia markets for LNG deliveries, generally much lower storage capabilities and rely on just-in-time shipments. So that's probably the most vulnerable market right now.
It's amazing. You say for Canadian oil producers, this could be a potential historic catalyst, turning this country's heavy oil into a premium product because it's reliable.
Yeah, and first and foremost, I would say that, we never predicate an investment thesis on human tragedy, and that the exogenous events that are happening right now, and the price that we're seeing, probably some strong cash flows as a result in the short term, that's not the investment thesis. The investment thesis here is Canada as a reliable source of crude stock for refineries around the world. Now, there are some limitations to how we can ship that. We do have good volume that we can export out of the Gulf, and we have a little bit of spare capacity in TMX, where that spot capacity can probably be sucked up here in the near term. A little bit of a time lag to do that, but it really does show, a lot of these businesses in Canada, they have become anti-fragile. They've had to deal with a number of issues, regulatory, poor pricing for differentials, and also weak crude pricing. And the sort of efficiency and the strength that they run their businesses at really functions well at a much lower price than it would have 5 years ago. And when you get these sorts of events, it just sort of underlies the strength of that business model. And to us, that should re-rate the multiples for these businesses.
Two stocks that have caught your eye. Start off with Vermilion. What's your thesis there?
So my partner Amir covers Vermilion. The thesis on that stock would really revolve around their European gas production and being a beneficiary of the strength that we're seeing in European gas markets today.
And then also Valeura, because they have markets outside North America as well.
Yeah, and again, my partner Calvin covers that particular stock. And it would be the same sort of thesis: access to Asian markets today for their production without the war risk of shipping those volumes. What I would say is that a couple of Canadian businesses that we would look at, Cenovus, they have the ability to ship crude. I actually spent last week in Texas with the company. Oh. This was before the events of the weekend, and we were pretty positive coming out of that trip. Without what's happened here. But one of the things that they talked about while we were on the road was their ability to ship their heavy crudes out of the Gulf as well on TMX. And so they're going to be able to capture some of this value here in the short term. But, outside of this sort of shock that we're having in the short term, we thought that the business looked very well positioned otherwise.
Valeura is interesting, because they produce oil in the Gulf of Thailand, and Thailand is among the countries seen as extremely vulnerable to any cutoff or hike in price of oil.
Yeah, and that's one of the things we talked about in the report there. Yeah. If you look at Asian storage levels, some of them are actually pretty robust coming into this, particularly China. We would say that there's a bit of nuance to that. The teapot refineries in China were more vulnerable than larger refineries that had access to the SPR. We would have seen India coming into this as having a bit of a weak crude oil storage position, and so they're going to be vulnerable if this persists for a while.
We'd better jump. Thank you very much indeed for joining us, Patrick.
Thank you.
Patrick O'Rourke, Managing Director at ATB Cormark Capital Markets.